But when you have a mixed portfolio, there's no way everything will hit stop loss at a particular point in time.
So today we are going to talk about trading. We are going to have some discussion about trading, and we will just jump straight into it. So, look, how has trading been for you over these months?
Yeah, this month has been quite choppy. Uh, I mean, with forex, you should always anticipate that at times the market will not go um, as you intend it to go, but we would always look out for the best opportunity and come back strongly. Yeah.
Okay. So, talking about choppy, what does choppy mean? Can you show us what choppy is?
Okay, so in the market, there are two phases of the market. We have the impulsive wave and the corrective wave. So there are two waves of the market. Now, currently on the higher time frame, we are actually in a corrective wave. Now, most of the choppy situations occur in the corrective wave. So the market has not been straightforward. Once the correction finish, then we'll start another impulsive wave where a lot of traders will make a lot of profits. But for now, since we are in the corrective way, you should anticipate a lot of, should I use the word choppiness? Yeah.
What is the highest profit you've made in the market?
I've been able to move about 8,000 to 128,000 USD. Yeah. So that is possible. I've made a lot of profit. But when you talk about a day, since you're a swing traders don't make their profit in a day because they have to leave their trades overnight. But my highest profit I've seen so far within 2 weeks, it's about 120,000
So
USD.
that one you are risking.
Should I say
50% risk.
um kind of, I was trading crypto at that point. So, I'm a risk averse trader. So once I was trading crypto, crypto was moving very fast and I was trading on margin. So it seems the profit just came in. I was just raking the profit. In fact, I can sleep, close my eyes, place a trade, and I'm in profit. Amazing. So it is what it is. Sometimes you have it very cool. Sometimes it's quite.
Do you think traders go through phases? Like there are phases in trading?
Yeah. For me, learning forex is very, very easy. But learning is very, very easy, but mastering it can be very difficult. That is why you need an experienced mentor, a mentor that has been quite consistent and relevant on the forex market for a while. Tap into his psychology, tap into what he's doing right. Because for our time, I have over 15 years experience trading on the market. For my first 5 years, I was making money, losing it, making money. So 10 years after, that is where I started seeing some consistency. Now, um, we during our time, we didn't have some like a great mentor in Ghana here who could take us through. Like now you have mentors who have gone through the rigid way to actually learn forex, so they've seen it all. Yeah. By our time, we didn't get such mentors. So 5 years, we were making money, blowing it. In fact, my first 5 years, I didn't even know how to calculate my position size. So now, traders have the opportunity to learn.
Yeah, ups and all that.
Yeah, so
Okay.
I had to learn from a few guys, Catilian and all, Timothy Sykes and all those people. But there are phases. Now, currently, when you learn the skill of trading, um, for example, when you go through my smart forex trading course, you first learn the theory and you learn the price action trading, which is very basic. Some institutions they teach it in the advanced level, but I teach it in the beginner session. Now, my advice to traders is that when you are beginning, learn everything you can chance on. You have to learn everything. Whatever you see on YouTube, books, baby papes, whatever, learn everything.
Do you think some people are born good traders?
People are not born to be great traders, but um, people who have passion tend to succeed on the forex market. Forex is driven by passion. If you are money driven, if you understand why you want to make money on the forex market, that passion of money drives you to learn every day. And forex is one of the skills that has a direct relationship with money. The more you learn, the more you become better. So it's not about people being born to be forex traders, but people who are well driven to succeed in forex, they turn out to be quite successful in the forex.
The reason I'm asking this question is, some people are born footballers, like they are naturally talented with their feet. Some are talented with their hands, they are instrumentalists. Some are singers great with their voice. Like when they are born, they are just singers. They don't learn it anywhere. Kids are doing amazing. So I'm just wondering, with this era, do you think maybe someone is born a trader? He knows the chart.
But nobody was born with the chart in the head.
So maybe nowadays
It's about practice. It's about passion. What drives you? Forest is like a journey. Yeah? It's like a journey. So there are so many obstacles. And once you are motivated enough to go through those obstacles, the journey is very, very good, because it's not rosy like that. Now it's even easy to learn forex. At first, it wasn't so easy. So the passion is what will drive. Because see, the moment you lose one, two, you give up. This is real money you are losing. So the moment you lose one, two, you give up. But you should also look at the fact that you are building a career for a lifetime. So something should push you on. Once you lose, learn from it. Why did I lose? You understand? Why did I lose? What can I do to become better? Was it when the trade hit my stop loss? Did it continue to move in my favor, or it went against me? Then if that happened, then you should check that the problem is about risk management. Did you calculate your position size? Did you know the correct loss size for you to place the trade, so that when you lose exactly the amount that you want to actually lose in the market? So I don't believe in trading psychology. I believe in the practice of risk management. Okay, so the skill of being able to calculate your risk. So risk management and trade management is what people term as trading psychology. I don't believe in trading psychology. Trade management and risk management are the tools. Apart from strategy, you need trade management and risk management, not trading psychology. Because calculating your position size falls under risk management. When do you add on new position? When do you move your stop loss to break even? All those things are trade management. There's nothing like trading psychology, from my opinion. Because once you do those things right, your psychology is set right. Okay, so you shouldn't you shouldn't refer those things as trading psychology. So you should learn the skill of trade management and risk management. Because for strategy, even 50% profitable strategy can actually make you a lot of, even 40% can actually make you a lot of profit on the forex market. So I don't believe that strategy is the ultimate goal, but your trade management skill and your risk management skill is the most important asset that every trader should have in his arsenal. So let me show you an example of why I'm saying even 40% risk, 40% profitable strategy can actually make you a lot of profit. Let's say trade 1, 2, 3, 4, 5. Yeah. Trade 6, 7, 8, 9, and 10. I start seeing profit when I understood these 4 words. Trade more, risk less.
Okay. So what does it mean? What does it mean to trade more and risk less?
Trade more doesn't mean that, I mean, I quite remember I said this thing, and a lot of people were against the fact that I tell people to trade more. No, trade more doesn't mean that any trade that you see, you just take it.
Okay.
You pick quality trades. You understand?
And what are quality trades?
Quality trades are trades that has low risk against a higher potential reward.
Okay.
Now, once you understand that forex trading is a probability game, okay, your entire forex journey will change forever. It's a probability game. Anything can happen. There is nothing like a share trade.
There's nothing like a short trade.
There's nothing like a short trade.
So how does a trade become a quality trade if there's nothing like a short trade?
We see trades. We should always anticipate that we are trading based on a strategy, but there's no perfect strategy. There's no 100% strategy that is 100% perfect. You understand? So you should understand that all trade setups are of, I mean, they have some sense of probability in nature. So quality trades are trades that if I look at the trade, the risk to potential reward is, let's say, 1:2 or 1:3 and above. For me, I don't take trades that will give me minimum, that will give me less than 1:3 risk to reward ratio. Okay, so let's take, for example, your trading strategy is 40% profitable. Yeah? What does it mean? That means that for any trade, I want to risk 1% of my account and look for trade that will give me a minimum of 3%.
So you are saying if your strategy is 40%, meaning if you take 10 trades, you only win 4.
Yes.
You'll still be profitable.
Yes.
Okay. You only win 4, you lose 6. You'll still be profitable.
Yes.
Okay.
Why?
How does that calculation work?
So that is where the risk management aspect comes in. So you want to, the same patience that you have to see your trade hit your stop loss, have the same patience to see your trade hit your take profit, and take advantage of the winning trades, okay, and add new positions, which we call it scaling out. Yeah. So now, once your trade hits your stop loss, you are losing 1%. What is so bad about 40% profitable strategy is this. Now, remember I told you that out of 10 trades, even if you win 4 and you lose 6, you are still going to be profitable. Now, the question is, what percentage of your capital are you risking per trade? Imagine you are risking 20% per trade. What shows that your first 6 you will not be in a loss. So if you are in a loss with your first, even though it's 40% profitable, if your first 6 you are losing 20% of your capital, 2020, by the time you reach your fee trade, your money is gone. So you should minimize your risk. So let's say if it's your own capital, my advice is that if it's your own capital, you can risk maybe 2% per trade. And if it's a prop firm, you can risk, let's say, 0.5 or 1% per trade. So the 2% per trade, your first trade, you have 2% loss. So let's say you have this one loss, 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 win, 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 win. Now you can see that you have 6 trades in a loss, 4 trades in a win. So the first loss is what? 2%.
2%.
Second is what?
2%.
2%. 2%. Yeah? 2%. 2%. 2%. So 1:3. So if you are risking 2%, the 3% becomes what? 6%.
Okay.
Yeah. So 6%, 6%, 6%, 6%. So let's say you have $10,000 in your account. Yeah? Let's say you have $10,000 in your account. Now, you risk 2%. So 2, 4, 6, 8, 10, 12%. Okay? So that means that, and here you make what? 6, 24. 24 minus 12 is what? 12%. Yeah?
Okay.
So in actual sense, but one thing you should note, which a lot of mentors don't tell you, the more you lose, the more it is very difficult to come back. Now, if you lose 2%, cumulatively, your first 2%, the money will reduce.
9,000 something.
Yes. Then on the 2% will be on the 9,000.
Yeah, on the 9,000.
So it is not actually on
the
10,000 in the second trade. So even with the, with the 12% that you lost, in actual sense, it might not even be 12% because you'll be calculating it on the equity, on the outstanding balance.
Yeah.
You understand? So it will not even be that. But when you start making 6%, the 6% will also be on the balance. So yes, in actual sense, you might still end up with the 12% because it will also be calculated on a smaller equity. And as when you are winning, as it builds up with the new equity. You understand? So let's say you make profit, even though you lost 6 and you won 4, you still be profitable what? 12% plus 12%. So there is a rule, yeah? There is a rule which I call it the 1:5% rule. So that I risk 1% per trade, and in total, I should not risk more than 5% per trade.
For the day?
On my running trades.
On the running trade?
Yes. So if I lose 5% a day, I stop trading.
No, but what if you are a swing trader? How would you even calculate your 1%?
So if you are a swing trader, let's say you have 5 positions, yeah, and your trades are all in a loss. If you reach 5%, you stop trading. But you could also see that even within the 5 trades running, if you are risking 1% per trade, if you are risking 2%, then that means that you should not place more than 3 trades. You understand? But if you are risking 1%, then you can have like 5 trades. You get it?
Yes.
So you should be able to have a trading plan or a risk management plan. The same way you have a profitable strategy, you should also have a risk management strategy, which the strategy should also include a trade management strategy. Once you have your risk management strategy, which you don't want to risk 5% at a go, okay, you should also know when to shift your stop loss to break even, okay, when should you add new position as you are going along the trend of the structure.
So when do you add to trade?
Okay, so first of all, you should understand that with your risk management strategy, you should take into consideration currency correlation. You understand? Now, in your portfolio, you should have one major pair, because Euro USD, when Euro USD is buying, Pound USD will buy, NZD USD will buy. What you can do is that you can compare all those currencies and look for the one that is lagging behind. So maybe Euro USD has gone about 50 pips, Pound USD has gone about 10 pips, NZD USD has gone about 20 pips. So you can see that Pound USD has just moved 10 pips. So the probability is that it can move to catch up with the other ones. So you rather, instead of going for Euro USD, Pound USD, NZD, you only go for what? Pound USD. Then you then move to minor pairs and look for one setup, do correlation. You can start with the Japanese pairs. Yeah, you can look at the minor pairs and look for one that looks so good, and you pick that one. Then you come to maybe commodities, gold. Okay, you can look at gold. You can look at um, other commodities. Okay, then you take one indices. So you see that at every point in time, you will not hit the five, because when you take pound USD, NZD USD, euro USD, the chances that all of them will hit stop loss. But when you have a mixed portfolio, there's no way everything will hit stop loss at a particular point in time.
Okay.
You understand? Yeah. So once you have that in place, now if one of them, if let's say you're having 5 trades running, okay, then your trade is moving, it creates, you are in an impulsive way, it's going up, yeah. Then all of a sudden you have a very good correction. Let me clear here. So you have an impulsive wave like this with the internal structures, yeah. Then you have this. Let's say you place your trade over here. Now what's going to happen is that you have your swing structure forming, let's say this is a falling wedge, yeah. Now it breaks up here. Now you have your trade over here. Initially your stop loss was around here, yeah. So what you do is that once it breaks and give you a retest, you add another position over here. Now before you add another position, you should make sure that this trade you shift, because it has broken the trend, you shift this stop loss to this point. Then you add another position. So once this one is, let's say, euro USD, the rest are in a loss. Okay, maybe Nasdaq US 100, yeah, is in a loss. Maybe gold is in a loss. Maybe euro JPY is in a loss. Yeah, 1, 2, 3, 4. Yeah, which one again? Let's take exotic pair. Euro Turkish lira. Okay, it's in a loss. Now you are risking 1%, 1%, 1%, 1%. This one makes it 4%. But this one has broken and it's in profit. So at this point, since it has not hit the stop loss, at this point, you are in 4%. I mean, your account is 4% at risk, because this one has now moved into profit, and you've shifted your stop loss from this point to this point. So now, once you shift your stop loss here, this one becomes a risk-free trade. The worst is that you can come and hit this one and you make small profit. So at this point, since this one becomes a risk-free trade, you can now add a new position over here. You understand? Then once you add a new position, even though now you have 6 trades running, yeah, it is still 5%, I mean, at risk. Your account is 5% at risk. Even though you have 6 trades running, each of them you are risking 1%. So you add new position, it goes up as an impulsive way, create another correction, breaks, okay, you add another position here. This stop loss here, you shift it here. This one that has a stop loss to over here, you shift it over here. Then here you add another position. Now you have 1, 2, 3, 4, 5, 6, 7. But still, you are 5% at risk. Because now 2 of them will now be in profit, and you've added another position.
So it's not even 5% at risk, more of 3% at risk, because now you have shifted some into profit already.
Yes.
So they will cover.
Losses. But you see, the reason why you are 5% at risk is that even though you've shifted, you still have trades that you've entered. Okay, so now you have 1, 2, 3, 4, 5, 6, 7. All these ones are in a loss.
But then the first
plus this one is in a loss.
Okay.
and this one are in profit. So this is in a loss. 1, 2, 3, 4, 5. That makes it 5% at risk.
But then the first ones,
the first ones, they are in profit.
yes.
So they are risk free. But the ones which are not moving to profit becomes, a risky asset. So it then becomes still on your 5%. So by the time maybe this one will end, maybe some of this will then move into profit. So you don't expect to see all your trades in profit, at a go once you are having a mixed portfolio. But you'll be able to manage the trade side that it will be moving to profit. As and when it wants to move, you shift stop loss to break even and all those. You manage the trade. So trade management is also a skill that traders should actually learn to be able to master the act of trading.
All right. Our conversation is becoming more interesting, but we'll have to end here for now, and we'll bring you the part 2 where we talk about the risky trades he ever took and some crazy things he did on the market as a result of being an amateur. So follow us for more, and we'll come back again for another trade. Okay, peace out, dog.
Peace out.